Welcome everybody to the Capital Wealth Management Employee Education webinar. My name is Rebecca Records and I'm the Director of Retirement Plan Services here at Capital Wealth. I'm joined here today with Will Tuttle, who is our Chief Investment Officer. You'll also see on the screen Peter Lofton and Lee Duckworth, who's also your advisors on your 401k plan. If after this presentation you should have any questions, please feel free to reach out to any one of us and we're happy to take your call. Today's webinar, we're going to focus on two areas. One is just to recap the 2016 Q3 markets. And then second, and this is a very popular question that we've been getting, is covering the presidential election and what that means for the markets. So with that, I'm going to hand this over to Will Tuttle.
Hi everybody, thank you for joining us today. The first slide you can see here is how the markets have done each quarter for the past year, year and a quarter. The U.S. stocks did very well in the third quarter, up about 3% for large stocks, almost 9% for smaller stocks. International indices recovered after the uncertainty that plagued Europe earlier in the year, both with some economic slowdown and the UK leaving or voting to leave the European Union. So emerging markets were up almost 8.5%, and the developed foreign market index was up almost 6% for the quarter. Very impressive numbers for the third quarter. The big news, as I'm sure everybody is aware, is the election coming up in November. Two very different candidates are vying for your vote. And despite all of the drama that is surrounding this election, it's good to take a step back and consider what presidential elections have meant for the U.S. economy and stock markets in general in the past. Some of the key considerations to look at when you're thinking long-term about investments in a very divisive political season such as we're in is that companies and the stock market favor certainty. They want to know what is going to happen so that they can make plans and hire people and spend money knowing as best they can what the outcome is going to be. So to the extent that whether it's the president or the Congress sets the tax rates or sets a minimum wage level and it's going to be steady for several years, companies prefer that, and stock markets as a result tend to do better when there is some certainty in our political system. External influences tend to have a larger impact than just what happens in our political season as a result of elections. So unfortunately, terrorist events or foreign currency crises or other things that happen that are surprises outside of our political system usually cause the most disruption and usually cause the most volatility in our stock markets. And finally, the way that the United States was designed almost 240 years ago really helps limit government intervention in the day-to-day running of our economy. And as a result, when companies and individuals can make choices that will benefit them as opposed to just what the government wants them to do, people tend to be better off. Democracy is a very messy form of government. It relies on individual people, millions of them, making millions of individual choices as to who they want to represent them at various levels of government, whether it's your city mayor or town council, to your state legislature, your state governor, Congress, the Senate, the president. There are a lot of levels of government in the United States, and individual voters get a say in all of them. That makes it a very inefficient process, and this is by design. The drafters of our government did not want a single branch, whether it was the executive, the legislative, or the judicial, to have more power than the others over many facets of individual and corporate lives. So to the extent that none of them have too much power, people and companies are left to make their own choices and their own decisions. This relative freedom of our system allows people to go about their day, for the most part, without a lot of government regulation or more than is really necessary to get done what needs to get done. And the amount of regulation that takes place really has no bearing on what parties either in the White House or controlling Congress. Laws get passed no matter what and no matter who's in power, because otherwise there's no point to have a Congress or a legislature. So there's regulations coming and going all the time, regardless of whether a party says it wants more regulation or not. There have been many studies done on election years and actually the specific years of a presidential term. And the summary of all of them basically comes down to there's really no correlation between what party is in power in the White House and how the economy and thus the stock market performs. There may be a little correlation that a Democratic president and a Republican Congress leads to better stock market returns, but there aren't enough of those type of administrations to really say for sure that that is a reason why. It may just be coincidence. Presidents can only set the agenda for the economy and the direction that they would like to take the United States. The president cannot simply make policy, make things happen, or spend money. That relies on Congress passing laws that the president then signs in order to make that happen. So when it comes to this particular election cycle, you're hearing some candidates pledging to do this, some candidates pledging to build that. That is going to, that really is not going to match up with the reality of what they can do once they get into office. The Republican candidate would like to build a wall. The Democratic candidate would like to increase your taxes perhaps. But until Congress passes bills to make those things happen, that's just talk. So keep in mind that even if a presidential candidate is really adamant about getting something done, it still relies on the other branches of government to actually come about. This slide is a look at how the Dow Jones Industrial Average, a stock market index you can see every day on the news, how that index has done with various presidents in office. Top part is Democrats and the bottom part is Republicans. As you can see, the Dow Jones index usually goes up regardless of who's in office. The Great Depression under Herbert Hoover, 1928 to 1932, that's really the outsized stock market decline during any presidency, and the outsized recovery under FDR, who served from 1932 to 1936, as the recovery from the Depression started. That had an outsized return on the upside. If you take out, those outlying returns, most of the time the stock market goes up almost the same amount, or there are equal numbers of stock market returns of the same amount, regardless of who's in office. This chart is going to just highlight why investors should be invested in the stock market according to their allocation and according to their individual preferences, according to their risk profile, time horizon, tolerance of volatility, and so forth. But the bottom line of this graph is to show that you should stay invested regardless of who is in office. Again, historically, no one party makes the stock market do better than another, so there is no reason to not be invested if a Democrat were elected, or to invest more if a Republican is elected. That just doesn't seem to work out. And this, however, may be statistically significant. The stock market does a lot better when Congress is out of session. And why is that? That is because the government can't change the rules or take your stuff when they're not around. So it's easy to make a joke about, when government's not in session is the only time that the people are safe. But that does tend to be a little bit true. And again, that's because stock markets and companies and people enjoy when there is certainty and they understand what the rules are. When Congress is in session, changes happen to tax rates, changes happen to minimum wage rate, and so forth. That causes uncertainty, and that causes companies to change their plans. Prediction is very difficult, especially if it's about the future. Past results are no guarantee of future performance. That goes for almost anything, and is specifically true about economic performance, depending on who's in office. We can try to make some predictions based on polling results. This prediction about whoever wins the presidential election, the Republicans will likely retain control of the House of Representatives. That may change depending on some polling results. The debates have had an impact on some Republican candidates for the House. But regardless, it is going to be a very divided Congress, and neither party is going to have a strong majority in the House anyways. And prediction number 2, regardless of who controls the Senate, the next president is not likely to have enough votes to override a veto. The president is not going to have the ability to veto a bill and not have it pass from the Senate. So again, we have going to have a very divided Congress. Even if one party has a majority, it is not going to be a big majority. And in order to get anything done, some of the more centrist party members on both sides are going to have to cross the aisle. A strong economy, which is defined by declining unemployment and lower inflation, tends to result in a win for the incumbent candidate. Of course, this year we have the second term of Barack Obama ending, so we are going to get a new president regardless. And people's perceptions of the economy are more important than statistics. If people think that the economy is headed in the wrong direction, regardless of what party they're in, they are going to spend less and save more because of the uncertainty that they feel is coming, and do not want to be exposed to the stock market if they feel that things aren't going the right way. That's more important than actually who is in office at the time. So what does this mean for investors and participants? Again, participants who are closer to retirement should have a more conservative investment portfolio than a employee who is just starting out in their career. The election cycle probably creates more noise than signal, meaning that there's more news and more things to make you think about what is going on, but really isn't having an impact on the underlying fundamentals of the market or the economy. That news, that drama that we see every day, does increase short-term market volatility. And if we see that one of the candidates is gaining a large enough lead that the outcome really is not in doubt, the stock market should settle down as we get closer to the November elections. However, if it continues to be a very tight race and the vote can really go either way, we may see some more volatility in the short term. 401k participants who contribute the same percentage of their income every paycheck automatically benefit from dollar cost averaging. That means when a certain asset class or a certain fund category is up, you're buying fewer shares of it, and you're buying more shares of funds or categories or asset classes that are undervalued. And over time, as undervalued funds do better and as overvalued funds come down, you're going to end up doing better in the long run. As your average cost per share is reduced, you stand a better chance to gain over the long term as a result. Again, this does not guarantee that you will do well, but this process has been shown to provide a greater potential for a good outcome, but of course we can't guarantee that.
Thank you, Will. That was very informative.
You're welcome.
Again, if any of you have questions, please feel free to reach out to us. We'll be happy to take your call, and we look forward to hearing from you. Thank you.